All right. Doesn't that look fun? I watch that. It's like I can't wait for the barbecue to come. Just looks so much fun. And great people here. We have our balloon extraordinaire lady. Where are you? There, right there. So there she is. So wonderful balloon stuff. But anyway, oh yeah, videographer. That's Drew over there. So anyway, thanks for coming. We have a full crowd. Sorry, apologize I didn't get the salad, I guess. We ran out of salad. But so we have, okay, which way do we go? Okay, this is our, I guess I'm going to call it spring version for 2024 for our market update. Today, I didn't hear, or we won't hear for about 8 more minutes, what the Fed's going to do with the interest rates, but most likely they're not going to raise the interest rates today. But we're going to read the minutes to see what they say, so we read the tea leaves to see what's going to happen with the economy. Disclosures, whatever we say is just for general use. Don't take it for the gospel. If you have more questions, come and ask us or see a CPA or an attorney. We have to give that disclosure there. Okay, we're going to start off with my difficult part, talking about the building and a few changes. Nathan's going to talk about what happened last year. Pretty good year last year. So he has a fun part, because remember last year, 2022, wasn't any fun to talk about. And then Daniel's going to talk about the 2024 election and how that affects your finances. And then Jamie's going to talk about the outlook and what it means for you. Okay, you have at your desk surveys and notes, so please take notes. And then the survey, please complete them. If you have questions, you want to come in, you want to schedule an appointment, whatever please fill those out and leave them for us to have so we can get a hold of you if you want. It just makes it easier so we know what's on your mind so we can schedule an appointment. That's why we do these, is 91 people here. To meet 91 different meetings, that's going to take a long time. So we do this just to help for those that have simple questions or just want to get an update, and it's a light way to connect with us. Okay, I talk about the fun stuff, not investments, but we're going to talk about our building. You see what's going on next door to our office? Currently, we have our old office here. And it's been there. We bought it in 2001, the month before 9/11 happened. It's worked wonders. It's just been great for us. But we've just run out of room, and we just need to expand. And before I step out totally out of the business, I realized we need to build a new building for the newer people so they have room and newer and updated everything. Because that building was built in 1954. And Dennis Bailey remodeled it and put a roof on and stuccoed and everything else on top of it. So there's a house over a house, or an office over a house. So there's a house under that. It's kind of weird. So anyway, but we're having problems with parking, stairs, handicap accessibility. Yeah, Ann knows all about that. She's been fighting that for 20 years. Restrooms, space, technology, and everything else. So we're gonna update, and that's our office. And you can see it's 2 stories, and if you drive by now, the thing looks huge. It's pretty big. So it's going to be all new. Second floor is going to be rented. We don't have anybody yet, but we have many companies looking. If you know anybody who wants to go to an office place, it's going to be wonderful, high tech and everything. Okay, if you don't know where it is, it's just north of our office. And it looks kind of like, well, that's us at the, groundbreaking. And then that's what it looks like today, pretty close. So it's 2 stories, and it's going to be pretty awesome. So that's the new building. And notice here, also, we got all kinds of new things. That's a new logo. It doesn't look that much different, but it's just been spruced up. Jessica and Jamie and Charity in the office have been working on changing it, so it's going to be on our new sign. And the new sign is going to have bigger letters, 8-inch letters, that you can actually read our stuff, because everybody's getting older and they can't read those signs. So now it'll be easier. bigger, fancier. Everything's going to be nicer. So that's our new logo we have going on. Okay, we all know about the wonderful update with Charles Schwab. Most of you, it went pretty well. For us, it was it was pretty rough. Just when you change big companies, and we went from a big company to a humongous company, Schwab, the rules, the regulations, and everything else is just that much more. And so we struggled. Charity still has hair on her head, but she kept pulling it out every day. It's just when we're trying to get things done. So thanks for being patient with us. All the changes we've had to make and updates and everything else. And people were very understanding. They'd call and say, I can't get logged in, and Charity and Jessica would help get you logged in. So thanks for being patient with that. And that's just what happens. You know, Janet and I went through 3 other mergers in our career. So those are much smaller companies and much easier to deal with. Now when you're dealing with Schwab that has $7 trillion, they're just so huge that the compliance department is probably as bigger than this room, saying the only one word they know is no. You know, that's all. Can you do this? No. Can you do this? No. Why? What do we need? You need a signature on this paper. It's like, So anyway, so thanks for that. And then do know you're going to get 2 forms, tax forms here. Pretty soon you're going to be getting it. Some of them have got them if you get the 1099-Rs for your IRAs. But you're going to get a tax form from TD Ameritrade and from Schwab. So make sure you get those. If you don't have them, we have them, right, Charity? Okay, she says yes. Okay, so we have them, but just know when you go to your accountant, don't just bring the Schwab or Ameritrade, bring both of them, please, so you don't get an audit. Okay, pretty simple. And updates, talk about paperless. Schwab and every company in this world is really trying to go to paperless. And I know all of us, and I deal with it too, technology is just harder and harder and harder to deal with. And you can use paper, but it's just really much easier to go paperless. So if you can do that, we'll help you, we'll train you. You can come in, we'll sit down, hold your hand through the whole thing. But it does make it a lot easier. The neat thing is, like on your own accounts, you can go in and change your own beneficiaries without calling us. Now, we want to help you. We're not shoving that over to you, but these are features that you can do on the paperless side. Okay, and then now we have Nathan. Nathan's going to be talking about what happened last year, which was a very good year. So hopefully you'll enjoy his talk.
All right, like he said, I'm Nathan Manus. So I've met most of you in the room at this point, but I've now made it to my 3rd ElderAdo seminar, and they haven't kicked me out yet, so that's pretty exciting. Well, I went the wrong direction. First off, before I start, I know some of you are cold. I saw jackets going on. Daniel turned the AC off, so should be warming up here in a minute. We got enough bodies to warm this place up fast. So last year, like Jim said, was a good year, right? So really nice after 2022 to have a solid year. And I just kind of want to talk through some of what happened. I'm not going to talk through everything on here. You've got these on your table if you want to look at them closer at home later. But keep going the wrong direction. I'll get it eventually. So at the beginning of the year, the Fed was saying, hey, interest rates are probably going to have to stay high for a long time, going to have to raise them a bunch. There was a lot of fear about inflation. We wondered, when is it going to get under control? And then we had the banks. If any of you remember that, I know many of you do, because we got some frantic phone calls around that time. Then there was the possible default on our debt. Again, many more scary phone calls. And so the year kind of started out a little flat, nothing too crazy. But once the debt default kind of got set to the side, then markets kind of started to rally. Then when the Fed held rates steady, that really started to rally things a little more, kind of brought a lot of optimism. So let's talk about those rate hikes. Okay, so many of you think, hey, how big of a deal was it really? But when you look at what happened, we went in basically from March of 2022 to July of 2023, we went from virtually no rates to 5.25. And that is the highest it had been in 22 years. Sure, not what it was in the 80s, but 22 years is a pretty decent chunk of time. Another thing to think about is that it was also the fastest that rates had been raised in basically 4 decades. So starting back here in, well, I keep doing that. Starting back here in like 2000, 2001, rates were higher, but since then we've been in a lower rate environment. Now, after we got through that, markets started to get a little scared. And as they got a little timid there, right as we were wondering, hey, are we kind of leveling out here? Then next thing you know, Hamas attacks Israel, and inflation came in higher than expected, right? And at that point, markets went down and down and down. We're thinking, okay, where's the bottom? Do we need to make any changes? We kind of held steady with what we had and started to make some other changes that I'll talk about later. And then Fed held rates steady, and we had some good growth in Q3. So that brought quite the fast tick up there in November and the start of December, and then December finished with a nice Santa Claus rally. So in November, to kind of put it in perspective, it was the 18th best month for the S&P 500. Now, 18th doesn't sound that great. I mean, it's not like it was first place winner or even top 10, but that's out of 875 months. So 18 out of 875 ain't too bad. Now, I got a kind of funny phone call one day right at the bottom of the market. And it seems like we can predict when is it going to turn around, because that's when we get the most phone calls. And I'm like, oh, I'm not joking. When we get those phone calls, it's like, hey, something good's about to happen. So I changed his name here, but Bob and I were talking.
The phone was busy right now.
Yeah. So Bob called, and he was a new client and had been in just a very, very conservative portfolio for a long time. And then we started getting him invested a little more aggressively, nothing too crazy. And his account just started to tank there in September, October. As you can imagine, he's like, okay, these guys just stole my money and it's just dwindling fast. I got to do something about this. And we were talking, it's just like, please, hold on. Now is not the time to move to cash. Hang in there. I didn't anticipate how quickly it was going to turn around, but a couple of weeks later I call him because he never came in like he said he was going to. I was kind of scared when he was going to come in. And he just laughs when he answers the phone. Says, I got to stop looking at that stupid computer so much and just let you do your job. So I don't say that to say, oh, I'm so smart, you should listen to me, never question anything I do. I say that because it's not just Bob that's been in that situation. We've all been in that situation. We've all felt that way. And so I just want to let you know, you're not alone. I was having lunch with a client the other day, and he told me, he's like, hey, we're kind of all a family. We're all in this together. And I really like that perspective because it's so true. So a little more perspective on how good of a year 2023 was. We ended up above average over here in this column, in the 20 to 30 range, whereas 2022 was pretty rough on the opposite side of things. So also 2022 was a little bit of an outlier. Now, I want to talk about what drove the S&P 500 last year. It was the Magnificent Seven, but not these Magnificent Seven. It was those Magnificent Seven. So, and for those of you who don't know, Meta is Facebook and Alphabet is Google. So they were heavy into tech, big time into growth last year, and really skyrocketed. And they accounted for such a big portion of the S&P performance, especially in the beginning of the year. It kind of limped it along, and then the rest of the companies in the S&P 500 kind of caught up at the end of the year. But a big driver is like what we talked about in the last seminar of artificial intelligence. And you're going to hear a lot about that. I'm sure you already have. Most of it sounds scary, but just remember that if you have a smartphone, you are carrying AI with you all the time. So we see that these companies and many others, it's going to be a race to who can have the best AI integrated into their products the best, with the least glitches, all that stuff. So it'll be really interesting to see kind of how these companies jockey back and forth, and then there'll be some outliers that come out of nowhere and surprise us, I'm sure. So going back to kind of comparing 2022 and 2023, there's a lot on this graph. Please don't get caught up on it. Just look over in this section here. So 2022, look how much red in virtually every category, every different asset class, basically everything was down. 2023 was nice. The only thing that was down was commodities, right, which most of you didn't have much of in your portfolio anyway. So the Magnificent Seven really drove this huge return on the NASDAQ 100, and the only thing that beat that was Bitcoin. And if you want to learn more about Bitcoin, Daniel's the guy for that. And I won't talk too much on it, but long story short, there were ETFs that were approved to invest in Bitcoin, and that drove a big rally up, and then it's kind of held steady since then. So, of course, you're not all invested in the S&P 500. You've got, most of you probably have some, but you're diversified, as you should be. So international didn't do quite as well, but still positive. Just things have been weird the last few years with international. Generally, you're diversifying outside of the U.S. You know, U.S. doesn't do as well, international does, and vice versa. But with everyone kind of getting hit with COVID and having basically the same reaction of dropping rates to zero and then rapid inflation, basically the whole world has kind of been in a very similar cycle right now. I do expect that to normalize and start to see a little more diversification between international and U.S. over the next few years. So bonds, this is where a big percentage of many of you have in your portfolio. Again, more perspective. Look how terrible 2022 was. Can we just, have our moment to say thank goodness 2022 is over? And actually, 2023, bonds started out rough. Bonds were not doing well towards the first part of 2023. But again, that November, December, they really got a nice kick up to where we ended with a little bit more of an average year for bonds. And then basically what we were looking at, again, with the rapid rise in rates, is bond yields were going up, so rates were going up, which caused the prices to go down. This is what was happening in 2022 into the beginning of 2023. Right now, we're in a little bit more level. They've kind of leveled out where we're going to go. But the expectation most people have is that yields are going to start coming down. The Fed's going to start lowering rates probably in 2024. And when that happens, bond prices should go up. Now, the further out you are on the seesaw, the more it's going to change, right? So what we did is we took a lot of stuff out of short-term bonds, moved into a little bit more intermediate-term bonds. So then when rates do come down, be able to take advantage of that upswing without taking too much risk and going all the way out on the end of the seesaw here, just in case something does change. So CDs, were prior years getting basically nothing. So it was nice to have a return in CDs. A lot of people felt comfortable kind of laddering CDs, and we'd seen a lot of that, and it was kind of nice. Every time we'd re-up a CD, we'd get a better rate than the one before. But now we're kind of going the other way. And I think we've kind of passed the peak where we were getting rates up to, 12 months rates up to 5.6 or so. We're now down below 5% on 12 months. Now, is it going to go to 1% in the next few months? No. Do I expect it to continue to go down? Probably. So another big one last year was money markets. And if any of you were buying and selling a house, or you needed to sit on some cash for some reason, you know how awesome it was to have these money markets paying. At one point they got up to like 5.25%. And so to have a pretty safe place, I can't say risk-free, but safe place to stash some cash while you're waiting and at least get a decent return, especially during the volatility, really helped people weather the storm. And for some perspective, over the last 10 years, barely over 1% return in that money market. So it's not something that really has been a good option lately. So that really helped people get through some of the rough times this late summer and fall. So this year, not a whole lot has happened. S&P 500 was up a little bit. It's actually down today, like Jim mentioned. Markets are kind of trying to figure out what to do as the Fed is meeting right now as we speak. Bonds kind of aren't doing anything. They're still asleep, it seems like, but I do anticipate starting to see a little bit more change in those. Markets are they're optimistic. They're not coming down freaking out thinking, hey, we got too high at the end of 2023. But at the same time, they're not soaring up right now. And most of you could probably guess the reason why. It's just election year. People get scared in an election year, regardless of which way you lean. Trump, Biden, some other candidate. Most of you, when I say the word election, like the blood leaves your face. You just get, it's like, I don't know, you become ghosts. And I get it, right? We need to remember that Washington is a big machine. And yes, the president makes a big impact, but there's more to it than just the president. That said, I'm going to hand it over to Daniel, and he's going to talk a little bit more about elections.
I like my job. I really do. I like my job. But there are parts about it that make me want to hit my head against a wall. And that is including but not limited to the election. I can promise you that investing is 90% emotion and 10% head knowledge. And I like to tell everybody that I do most of the head knowledge at ElderAdo Financial. And the reason why I'm not really talking about investments this year is because I have to talk about the one thing that is more than likely going to dictate your success in your financial goals, and that is your emotions. Jim, Jamie, and I, and including Nathan, for years now, we've told you guys the same thing over and over again. We show you charts about the average stock market returns in the 4-year election cycle. We show you the S&P 500 and outlining every president and its political party since Kennedy. We tell you the same thing over and over again. It does not matter. Washington, D.C. plays a very minor, like almost non-existent part in the Wall Street. Wall Street does not care what happens in Washington, D.C. And if anything, and I might be breaking the news to you, Wall Street pretty much has Washington, D.C. in their pockets, and I can prove it to you. Here's the S&P 500 in 2023 and its performance. Here's every Democratic and Republican senator and congressman that outperformed the S&P last year. The big winner goes to Brian Higgins, the Democrat from New York. He got about 239%. Republicans Mark Green, Garrett Graves, and David Rouser all got over 100% last year. Needless to say, and I don't like to advertise for my competitors, I really shouldn't be managing your money. Nancy Pelosi should. Actually, no, I take that back. She only got, where is Nancy? Yeah, she only got 65% last year. I mean, really, Nancy? I mean, those are rookie numbers. We got to get those numbers up. So what I'm going to do this year is something that we've never done in ElderAdo before. I'm actually going to come up with a prediction. We are going to take the uncertainty out of the 2024 election, as Nathan said, And instead of letting our emotions dictate our investing, which 99.99999% of the time does not bode well, and I got enough stories to prove that, but I'm going to invite you guys. I am inviting you to use the same tools that I'm going to use to basically come up with a prediction of what's going to happen in November. The great part about it is that you all have the same access to these tools, okay? Now, the big reason why I'm doing this is so that way we can invite you all to practice what Jim and Jamie and I preach every single election cycle. Control what you can, let go of the rest. I can promise you, you have more power over the TV remote than you do Washington, D.C. Yeah. And let me just go ahead and say it, like the political ads on TV, can a man just like watch Wheel of Fortune with no disruption, please? So other than that, other than controlling our emotions and letting go of the rest and keeping our financial goals intact, we're also going to, if we need to make adjustments to your portfolios, we have the ability, at least to the best of our knowledge, to do that. Like I said, at the end of the day, it really doesn't matter what happens in 2024 in November, but if we need to make changes, we have the ability to do that. So, before I start, there are two very specific tools I'm going to be using to predict 2024's election. Now, you're probably wondering, Daniel, how do I know that you will keep your political bias out of the mix? Very simple. This is a screenshot of the Colorado State Secretary's website. This is the voter registration page. This is my name. Yes, my middle name is Braxton. You can be jealous. I have blocked out some personal information that you obviously should not know. But the big thing I want to highlight is my party affiliation. I'm unaffiliated. I'm independent. Now, you're probably wondering why. Nathan and I, in October of last year, were in Philadelphia for Schwab's Advisor Conference. And when you go to these conferences, every now and then you get to rub elbows with some pretty interesting people. I mean, executives of multi-billion-dollar corporations, and you talk to congressmen and senators, and you talk to, we had Bill McRaven, who was a 4-star retired admiral, speak at the conference, and I got to chat with him for a little bit. When you ask the right types of questions and you really start to piece together how the world works, you come to realize really how basically what my political philosophy and my political affiliation is. You want to know what it is? Here it is. There is no red, there is no blue, there is the state, and there is you. There is no red, there is no blue, there is the state, and there is you. And the sooner you accept this as dogma, I promise you, I will throw my hands on a stack of Bibles and swear to you, it becomes so much easier. And you will find out that investing becomes a lot easier too. Okay, so we're going to talk about the first tool that we're going to use to predict the 2024 election. And the best part is I don't have to do anything, really. Show of hands, how many of you guys have seen this man before? His name is Alan Lichtman. How many of you have heard of him? Well, okay, 1, 2, okay. So, this is Professor Alan Lichtman. He is a history professor from American University in Washington, D.C., okay? In 1981, he was approached by a gentleman by the name of Vladimir Borak. And Vladimir walks up to Professor Lichtman and looks at him and says, "We're going to collaborate together." And Alan looks back at him and says, "Okay, either you're crazy or you're a KGB agent." Vladimir Borak was a mathematical geophysicist, and he was also a seismologist. Seismology, in case you don't know, is the study of earthquakes. Now, you're probably wondering, well, Daniel, what does earthquakes and politics have to do with one another? I'm going to give you some very intimate insight with basically how my economic brain works. Okay, this is part of my philosophy. If you want to get the information you want and get answers to questions you desire, you have to be willing to look in the places you least expect. What I'm about to show you is a beautiful example of this. Professor Lichtman took election data from Abraham Lincoln all the way up to Ronald Reagan at the time. He plugs that election data into Vladimir's algorithms that he would use to basically predict earthquakes. He was the leading expert of predicting earthquakes at the time. And what came out was what's called The Keys to the White House. This is a book that you can go buy. There's plenty of stuff online that you can read more about. There's a bunch of different videos, and they show you how it all works. But I'm just going to go over the keys today. So with these keys to the White House, what they're designed to do is measure political stability versus political earthquake, okay? Now, what are the keys specifically? Well, there are 13 true or false questions. How many of us loved true or false questions growing up in school? You didn't need to be a genius, you just needed luck on your side. That's how I basically got through life. No, I'm kidding. So there's 13 keys to the White House, okay? So we're just going to briefly go over them. Key number 1, the midterm gains for the incumbent party in the House of Representatives. The incumbent party, just for quick definition, is the political party that currently holds the White House. So, did the incumbent party have midterm gains in the House of Representatives? Is there a primary contest for the incumbent party? Is the incumbent president, in this case would be Joe Biden, seeking re-election? Ooh, that's a good one. We should come back to that one. Key number 4, no significant third-party campaign. Key number 5, short-term economy. Are we in a recession? Ooh, that's another good one we should come back to. Key number 6, strong long-term economy. Is there any real per capita growth in the economy? Key number 7, major policy changes. Key number 8, there's no social unrest. Key number 9, I like to think of this as just a freebie because what administration doesn't have scandal? Key number 10, no military failures. What's interesting about the military failure stuff is that you may not have military failures, but that doesn't necessarily mean, key number 11, you don't have any military successes. Key number 12 and key number 13, I want to make an interesting point. Charismatic incumbent candidate and uncharismatic challenger candidate. Notice that only 2 of these 13 keys have anything to do with the personalities of the candidates themselves. Professor Lichtman argues that voters aren't easily swayed. They're very pragmatic. So just to highlight a couple, I think these keys, one other thing. Technically, we could use these keys right now to get an idea of what's going to happen in the election. Ding, 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 ding. Anyway, my brain just goes scattered when stuff happens. Okay, so technically, we can use these keys right now to get an idea what's going to happen in November. Are we going to today? No. We are simply just going to look at what these tools are, including the keys to the White House, show you guys how this works. When we get to the fall seminar sometime in October, we will do a quick review of these of the tools that we're using, and then we'll kind of review the data, see what they say, and then we'll come up with a game plan. So this is strictly just telling you guys what the tools are and explaining how they work. So technically, we could use these keys right now to get an idea what's going to happen in 2024. However, I strongly believe it is still way too early. Still way too early. Why? Key number 3. Incumbent President Joe Biden is seeking re-election. There's a lot of rumors and chatter and a bunch of stuff within the Democratic Party right now on whether or not Joe Biden is going to be a one-term president. Okay? Now, from what I can see right now, it looks like we're going to have a Joe Biden-Donald Trump rematch. However, we live in a post-COVID world. A lot can happen between now and November, so I'm not holding my breath. So we'll just have to wait and see. The other big key that I'm going to be focusing on specifically is the key number 5, strong short-term economy. Is there going to be a recession? There was a lot of chatter in the 4th quarter of last year of whether or not we're going to go into recession or not. So far, the economic numbers haven't shown any kind of slowdown. Of course, that can all change between now and November, so that's going to be a key to watch. Now, I've kind of picked on Joe Biden for a little bit, so let's talk about Republicans for a second. Key number 13, uncharismatic challenger candidate. Professor Lichtman likes to categorize this specific key as like the once-in-a-lifetime, once-in-a-generation charismatic leader that a whole political party can back. So like a Ronald Reagan, for example. The problem with the Republican Party is that they're super divided right now. Like, you got your traditional, good old boy, Mitch McConnell, traditional conservative Republicans, and you've got your gun-toting, mega hat wearing, Donald Trump supporters. So it's super divided right now. So we'll just have to see how Professor Lichtman categorizes these two keys, whether it's true or false. Professor Lichtman typically comes out with his prediction. He uses these keys, and he lets his prediction be known about 3 months before Election Day, so somewhere in early August. If you see him on Fox News or CNN or one of the two, you kind of get a clear idea of who he's going to call for. So now that I've talked about what the keys are, now we have to talk about how they work. So remember that there are 13 true or false questions. 5 or less of these keys answered false is against the incumbent party. So the incumbent party being the Democrats, if there are 5 or less of these 13 keys answered false, that means there's political stability. If there are 6 or more false answers on these keys, that means that there is political earthquake, okay? So how does this work? So here's the White House, here's Joe Biden. In case you need to be reminded, Joe Biden's a Democrat, and so you have the incumbent party, right? So 5 or less of these keys are answered false, political stability. Political stability means that the Democrats will keep the White House. On the other hand, if they get 6 or more false answers on the political earthquake, or on the keys, then that's political earthquake. Political earthquake means that the incumbent party, the Democrats, lose, and it goes to the challenging party, which in this case would be the Republicans. 5 or less, there is no mess. 6 or more, you're out the door. I'm like Dr. Seuss after he's had a couple drinks. So Professor Lichtman created these keys back in the 1980s, and he's called every political candidate for the White House ever since Ronald Reagan. He's called Reagan in '84, he called Bush Sr. in '88, he called Bill Clinton's race in '92 and '96, and he even called Al Gore. Well, wait a minute, Daniel, I thought you said that this guy was like super accurate. Oh no, he was still accurate. He had every reason to call Al Gore. When Professor Lichtman developed the keys to the White House, the outcome of the prediction was based on the popular vote. Reagan, Bush, Clinton, virtually every presidential race prior, if you won the popular vote, you also won the Electoral College. Obviously, in 2000, there was a divergence between the popular vote and the Electoral College. The last time that happened was in the election of 1888, where Benjamin Harrison won the election in the Electoral College, even though Grover Cleveland won the popular vote. Recognizing this minor technical detail, Professor Lichtman has since, and if you even recall the 2000 election, Al Gore obviously won the popular vote, went to George Bush, hanging Chad, all that stuff. So Professor Lichtman has since made minor adjustments to the keys, focusing on the winner of the Electoral College instead of the popular vote. And it's helped him out ever since then. He called George Bush's second term, he called Obama's 2 terms, and yes, he even accurately predicted Donald Trump and Joe Biden. Now, some of you are learning these keys for the first time, and a lot of you are going to be skeptical about the keys, and that's perfectly fine. I was skeptical too. But a couple things I want you to keep in mind. Not only did Professor Lichtman accurately predict a political outsider in an election where everyone and their dog said that Hillary Clinton was going to win, but he also accurately predicted Joe Biden in the midst of a pandemic. When he said that Joe Biden was going to win in 2020, I'm like, well, of course you say Joe Biden's going to win. I mean, our economy's in the toilet because of the shutdowns. I mean, there's all these riots going on in the big cities. They're all on fire. There's this, and there's that. I thought that his keys were skewed. Ended up not becoming the case. So, as I said, we're not using this to make any predictions right now. When we get to the fall seminar, we will revisit this, do a brief review, and then we'll actually look at what the data is saying and what Professor Lichtman predicts for 2024's election. So I can be lazy, and I can just use the keys, and I can just be one and done and see you guys later. But I like to look at multiple indicators. I like to look at multiple things. One question you might be having, okay, well, Daniel, well, what are the polls saying? Are we going to look at the polls? And the answer to that question is a big fat red no. If my college statistics professor was here right now and he saw that I was giving you guys data based on what the polls were saying, he would grab me by the collar and then just proceed to beat me, okay? The problem with polls, for one, is that you have a way small sample size of people being surveyed. You know, a poll of 5,000 people, 10,000 people, 20,000 people, whatever. I mean, 20,000 people is supposed to represent 300 million of us. So the big problem with polls is that their sample size is really small. The other problem with polls is that they have political bias. A new Fox poll, a new CNN poll, a new MSNBC poll. I mean, I'm just shoving out polls to feed whatever political bias it is to the audience that I'm catering to. So there's a lot of political bias that could get mixed in there. The other problem with polls is that they don't ask the big enough questions. Oftentimes they'll come out with a poll and it'll just be about the economy or about immigration and about all these other small, minute things, but they don't think about big picture. And the other problem is with polls, people lie. Show of hands, how many of you have never told a lie? Usually I get like one or two. So the joke didn't work, darn, okay. So if we're not looking at polls, what are we going to look at? What did I say earlier? You want to get the information you want, you have to be willing to look in the places you least expect. How many of you have been to Las Vegas? A few of you? Okay. Gamblers, bettors, people who put their money where their mouth is can give us a lot of really good and accurate information about our elections. I want to introduce you to a nifty little resource. It's called electionbettingodds.com. Okay? This is a website that was developed by two journalists, Maxim Lott and John Stossel. Those names might sound familiar to you. And the idea is really simple. You take a bunch of betting data on our elections, you compile it together into one place, you organize it in an easy way for people to read and understand, and you just watch what happens. So why are the bettors better than the pollsters? Well, for one, you got a way larger sample size. In the 2020 election alone, you have $400 million in bets. The other big reason that the bettors are more superior to the pollsters is that the bettors oftentimes keep in consideration other important factors. They cut out their political bias. Okay? The other big reason is that bettors think big picture. They ask the real questions. They're not just super hyper-focused on specific topics. They're thinking about the big picture. And because they got money on the line, I mean, they have no incentive to lie. They put their money where their mouth is. So how accurate are these polls, or are these bettors? This is just a simple little chart. I can go into like 20 different technical things to explain it and all that, but I'm just going to keep it simple for today. If you want me to melt your brain, just let me know. So the white line, if you can barely see it, is if the bettors have perfect accuracy. The blue line is what they actually got, what their actual accuracy is. And I don't know about you, but that's pretty darn accurate. That's after elections between 2016 and 2022, after 805 candidates. That's a lot of data, that's a lot of money, that's a lot of good accuracy right there. To give you guys an idea of what this website looks like, most recently we had the Iowa caucus and the New Hampshire primary. As of Tuesday evening for the Iowa caucus, Donald Trump was given 94% odds of winning. He ended up winning. And then DeSantis and Ramaswamy dropped out of the race, so a lot of those bets will shift over to different candidates. And then we had the New Hampshire primary. So 8 a.m. on Tuesday of the New Hampshire primary, Donald Trump was giving a 98% chance of winning, where Nikki Haley only had 2. And then sure enough, Donald Trump won. So am I going to show any more data about what the bettors are saying? You can go look it up on your own. I'm not going to show too much today because, again, it's still way too early, okay? Now, in October, when we have our fall seminar, like I mentioned before, we're going to review the keys to the White House. Hopefully we'll have Professor Lichtman will make his prediction. We'll see what he says. We'll also review the data for the election betting odds, we'll do a brief review of the keys and the election betting odds. We'll look at the data, see what Alan Lichtman and the bettors are saying, and then just more or less come up with a game plan. I don't expect us to do much, but if we expect something to drastically change or if we feel the need to make changes to portfolios, we'll talk about that. But I can't stress it enough. At the end of the day, guys, it really doesn't matter. And I want to stress this for a moment, okay? I want you all to remember that we have to control what we can and let go of the rest, okay? You cannot let your emotions just completely crumble your financial plan, okay? Jamie and I think we were like not even 5 months into our marriage, and she comes home from work. This was back when she was at Vanguard, and this was after the 2016 election, and she tells me the story about how a Vanguard client, he was so sure that Donald Trump was like the fifth horseman of the apocalypse that he bought high risk investments, basically betting the stock market was going to go down. Well, instead of the stock market going down, the stock market ended up going just through the roof. And this one Vanguard client lost $1 million in one day. Gentlemen, Uncle Daniel's going to give you some marriage advice. If you are going to have the manhood to lose $1 million in one day, make sure you reserve enough to tell your wife about it. Ladies, you have my blessing and permission to act accordingly. So, 99.99% of the time when we make investment decisions on our emotions, it does not bode well. Okay? Jamie, Jim, and I have seen it over and over again. Just please remember 90% emotions, 10% head knowledge. Give it up for Jamie.
All right, okay, guys. I'm going to bring it home. Stay awake, stretch if you need a little bit. I know we carbo loaded you with lasagna, so I won't take too long. But I just wanted to come here and share what we're looking at when it comes to 2024 and what that means for you. So I am our office's certified financial planner. Nathan's in the process of getting his, and the federal retirement consultant. So what does 2024 mean for you? Nathan shared what happened last year, where we were at. Daniel shared, hey, the election's coming. The main goal, right? Don't get so freaked out about the election that you lose your cool. If you need to talk to somebody about it, we're here. We're psychiatrists too. But we just wanted to share some tools that we use and some things to maybe take some unknowns away from you, because the unknown is scary, right? So I have this really nifty chart right here, and what a bunch of analysis they went out and said, hey, what are the big things that are going to happen in 2024? What's the buzz? Looking at a lot of different things, podcasts, articles, et cetera, et cetera. And it came up with this whole list right here. And there's a lot of things, and I don't want to talk about them all because, frankly, you guys want to go home and go about your day. But I highlighted a few of them that are kind of the big topics that I see, being relevant for your finances mostly. So the first one, increased geopolitical risk. Daniel talked a lot about what's happening in the United States election-wise. It's a huge election year globally. Actually, there's a lot of nations having big elections, so that's part of some risk that we can see. I'm not going to spend a ton of time about it. We have wars happening. Maybe another one will spring up. God forbid, let's hope not. But there's a lot of conflict happening. But the big thing that I want to point out when it comes to geopolitical risk, yes, short term, the stock market reacts based on news. Long term, there's little impact long term. When Ukraine happened, the stock market went down, came back. Same with Israel. So it's more short term when we're talking geopolitical events. They're not fun, but when it comes to your investments, not a huge area of concern long term. So, interest rates. Daniel talked about, Nathan more so talked about interest rates. He showed you some cool graphs and whatnot. The Federal Reserve did have their meeting today. They said, no, they're not cutting interest rates right now. We already anticipated that. They said not for a bit. So a lot of analysts are saying they're not going to cut it more than 6 times this year. I think 6 is a little bit much, but they're forecasting to still lower interest rates at some point this year. So this is just a cool graph of what interest rates have done historically for about the last 20 years. And it's a few different countries in the world, and ironically, they all work in sync, right? They all went down in the 2008 mortgage crisis, kept flat, increased, COVID happened, and then they all rose interest rates to try to keep pace with inflation, or try to quelch inflation. So what's the forecast, right? We're up here right now, and all the major countries are forecasting to lower interest rates. You know, there's some potential forecasts here. Don't take these as gold because they're not for sure until the Fed says anything. But we're expecting interest rates to be cut about 0.25%, maybe a few times this year, and continuing on into 2025. They don't want to lower them too quickly. But basically their main goal is to have them kind of be around the 2%-ish mark. So we have 3% for them to lower rates. So that's something that we're watching. That can have an impact on housing, right? Mortgage rates are going to go down. It will have an impact on bonds, which I will talk about shortly. And it will have an impact on what the government is having to pay in terms of interest on their bonds. So we're expecting rates to get lowered. And in relation to that, right now they're 5.25 to 5.5. So yeah, so about 3%-ish, a little bit more, that they're heading. So a lot of analysts are saying, hey, bonds are back, right? You saw Nathan's slide of bonds in 2022, which was abysmal and pretty bad for bonds. Usually they're somewhere in the positive because they're a pretty stabilizing investment, right? Bonds are part of your portfolio to help provide stability. They're not as volatile, they're not fluctuating all over the place, and they often provide some steady income. So what we're expecting to see is credit spreads widen. So what that means is longer term interest rates for longer term investments is going to increase higher, and then the short term is going to lower. This is the handy dandy seesaw that Nathan pulled up just to kind of explain bond prices and interest rates. Historically, we were over here when they were raising interest rates. That's why we were in short-term bonds. We've said this before. Refresher for those that have been here. But we're in an environment right now where they're going to have to lower interest rates unless something crazy happens. But what that means for you is if you have bonds, which almost everyone has some form of bond, your bond value is going to increase. So we're expecting if you have that intermediate term bond fund or short term or whatnot, the value of that's going to increase. So if we sell it, you're going to get a gain. So in addition to the interest rate payments you're getting gains as well. So that's something that I would expect to have happen for a lot of you this year. As we're rebalancing, you're going to see gains coming in from bonds. And this is what I talked about when I said credit spreads are going to widen. This is a normal yield curve right here, inverted right here. This is where we have been the last 2 years. So short-term bonds are paying way higher than long-term. That's not normal because it doesn't make sense. Long-term bonds are more risky, so thus you should be compensated for taking on extra risk. But it inverted, so this year we're heading back towards a normal yield curve where your short-term are not going to be paying as much as your long-term. So that's why we're looking at shifting investments from money market or short-term bonds here. Not down here, because this is too risky, but somewhere in here where you're going to get a great yield, but where you're not earning nothing. Next area, inflation. Everyone's favorite topic, favorite thing. Inflation, they're saying it's cooling, according to the CPI. Is the CPI perfect? No. We've said that before. But what we're expecting to have happen is inflation ceiling was around 2 to 3% in the 2010s. For that decade, inflation was low, interest rates were low. So thus, the ceiling was here. They're expecting that ceiling of the 2010s to become the new floor, so the base level of 2020s. And that makes sense. You don't have to be super concerned about that for the reason that bonds are in existence. So your bonds are going to be paying a little higher than what the inflation is what the goal would be. You have to be concerned when your bonds or your investments or whatever is paying below what inflation is, because then you're losing money, right? The cost of everything's going up, but your income's not going up. So as long as bonds remain at a spot, or dividend paying stocks or whatnot, as long as you're earning enough income to stay above this, you're going to be okay. They're also calling for a return. Did I lose this? Yeah, no, okay. They're also calling for a return to sound money. And what that means is just what I said. Interest rates are going to be above what the rate of inflation is. So you're going to be able to earn the money faster than what it's being eroded at with inflation. And you can see it bouncing all over, but since 2005, it's been in an opposite, where you're having to invest extra, or having to get bonds that are paying enough to keep pace with the cost of goods. So we're returning to sound money. I like that. That's a good place to be. It means you have to take on less risk to maintain your status quo of living. Oh, here was your question. Here's the interest rates right now. Here's where inflation is right now. So we have a little bit of a difference. I expect that to remain. All right, diversified portfolios are back. Were they ever really out? I don't think so. But as Nathan had showed in his slides, bonds, in 2022, everything was hit. Everything was just really getting slammed. So this is basically just saying we're not expecting everything to be hit like it was in 2022. That was an anomaly. And diversification is important. And that's what we do every day. We see a lot of people that manage it their own. They're too heavy in stocks. They're too heavy in fixed income, one way or the other. It's good to have a nice blend. What is that blend for you? It's so dependent on each of you and your goals. So I can't just make a blanket statement and say, you need this much in stock and this much in bond and this much in cash, ready, go. No, it's so personalized. So that's what we do. If you have questions about yours, talk to us and we can make sure you're in the right spot. But there's a lot of options out there. One of the things that we're looking at is money markets have been paying great, right? Nathan said it, 5.2, 5.24, wherever, somewhere in there. That's pretty great for a very, very, very low risk investment. But that's going to start to change. When the Fed lowers interest rates, that means the money market interest rate's going to decrease. So there's tools. Doesn't mean you have to just stay in cash forever and just watch it go down and down and down and down. And maybe if you're buying a house and that's money set aside for that, maybe that's what you do. We do keep it there. But if that's not the goal, we can do things like CD ladders, and we use all sorts of different investments to help earn what you need without taking on too much risk. So I'm not going to go into all the nitty-gritty of this slide, but it's just an interesting thing showing even investing, even if it's the worst time, even if you pick the worst time every single year to put your money in, investing tends to be better than just keeping it in cash. And I'm not saying that, if you're using the money for a house or a wedding or something that's coming up, there's a lot of clients that have an intentional goal for some of their funds. I'm not saying throw that in a volatile investment. But if you have too much just sitting in cash, look at what the Treasury is paying compared to even the worst timing putting it in the stock market. All right. One of my last areas, artificial intelligence, AI. It's all over this chart. I don't want to spend too much time on it, but it's very interesting, and we're watching it heavily because it's the future, right? It's where things are heading, like it or not. There's some cool tools with AI that I've started to dive in just to see what it's about, right? I want to be knowledgeable so we can help educate you if you need to know. So I've been trying and playing with ChatGPT. And some of you might have tried it. If you haven't and want to know more about it, let me know. I'm kind of having fun playing with it. But it's not perfect, and here's the story why. So about 2 months ago, I had to go speak at this economic event as the Chamber of Commerce president this year. And I was looking for some cool data on Montrose businesses. And I was like, I want to throw some cool data pieces that'll dazzle them. And so I said, let me just see what ChatGPT has. I was trying to find the data. I got some data that I didn't love, so I was looking for more. So I searched in, business or facts or analysis on Montrose businesses, something like that. And ChatGPT comes back and says, well, we don't have anything on that. You should ask your local Chamber of Commerce. I said, I am. So it's not perfect, right? If it's not out there, it's not going to feed it back to you. So we just have to be careful with it, right? It's a cool tool. Is it perfect? No. And it's not going to be that way for a long time, if ever, really. All right. My last subject, and a nice little video to start that. How do I play this video? Do I just click this?
Okay, I need more jokes, people. Ben is having his first day at work, so he cannot help me, so I need you guys to pick up the slack.
I have a joke for you.
Okay?
The government in this town is excellent and uses your tax dollars efficiently.
That's not really a joke.
I disagree. I find it hilarious.
I came across this literally last night, and I couldn't help myself. Whatever side you're on, we can agree that the government is not efficient in spending money. So I'm going to talk just very quickly on tax planning. And this is not for sure. This is conjecture and forecast. But in 2017, here were the tax brackets. There were some tax cuts that were put in 2018. And the reason we're discussing this now is because those tax cuts are set to expire at the end of this year. There's been some rumbles about some of them may get extended, some of them may not. If Biden said if he gets reelected, then he'll put them through. So we don't really know where we're at. We're watching those. But I'm trying to plan in advance for them not getting extended. If they do, great. But I have a hard time believing them getting extended because the government's spending a ton of money in paying interest on treasuries. So here's just a quick little tool just comparing. Some of them are not that drastic. Some do feel more. If you're comparing, right, we had a 28% bracket here to 24. So it really depends on your situation, but I'm doing a lot of planning in regards to this, specifically Roth conversions. This year we're looking at doing some of those just because if you can convert your pre-tax IRA to a Roth that's post-tax, you might be able to take advantage of some lower tax brackets, potentially, right? If those cuts are set to expire and you're going to be in a higher tax bracket next year, maybe we need to be converting some money. And maybe not all, maybe part of it. So and we're trying to look through clients that would probably be a good fit for this, but if you want to know, put it on your sheet, and Nathan and I can do some analysis to see, hey, does it make sense? And if so, how much? There also, the standard deduction may change to where it's back lower again. So that might mean some people get to start itemizing their taxes. So if that's the case, if you fall into the itemizing category, just make sure you keep all your receipts because you haven't had to do that for quite a few years, likely. And the other one is the estate tax may come into play a little bit more since that lifetime exemption is lowering. Oh. All right. I want to end with a little extra perspective. I've shared these similar charts to these before just because I think they're super cool. So here's a client that started off in 2005. And I was going to put some little arrows on here, I forgot. But the green right here is what they put into the account. So put in a lot, little bit of steady here, little bumps. That's what they put in. The blue is basically the total value of the account. So the difference between the blue and the green is growth. This account's been through 08. Know what I noticed? 08 is tiny on this graph. Did it feel tiny in it? No, it felt horrible. But it's tiny when you zoom out. Then you kind of head up. Here's COVID. It's drastic, but it's really not that big in the grand scheme of this, right? Even 2022, which was not fun. It's there, but in the grand scheme of it, look at how much growth there is. This is somebody that's accumulating, right? They're not taking money out. So let's look at somebody that is, or two someones. There were just two ones that I really liked that I wanted to put in here. But it's the same story. Green is what they initially put in or took out, right? Here they put money in, took a big out, took some out steadily, put a little in, taking it out steadily. This one's more of a monthly, we're taking monthly out. But look at this. What they started right here, let's come across. Even though they're taking it out, notice the green's almost gone here, but their account's at the same value. Pretty cool. Same on this one. Follow it across. Their account's at a very, very close value, and they've basically taken everything out that they ever even put in. So just when things feel bad, when they feel crazy in the moment, like 2008, COVID, whatnot, in the long term, we have a plan. This is why we have diversified portfolios, to help stabilize things for you, to help make sure that you have cash here, that you're not overspending. Daniel said this, and it's too good to leave. So we talked about a lot of things that matter today, right? A lot of things. We also there's also things you can control, right? But you can't control everything. You can't control who's going to be the next president. But there's things that you can control, right? You can control your emotions. You can control your decisions. So that's what you focus on, right? Focus on the things that matter and that you can control. And we're here to help you along the way. You're not doing this alone. If you're scared, if you're concerned, we're here to talk. But just keep this in your back pocket. All right. So to conclude, grab your survey. We want feedback, positive, negative, any subjects that you want us to cover in the future. Let's see, what else? Any questions you have, throw them on there. And thank you all so much for coming.